talking about capital gains on mutual funds and how you can offset it. Also, a little bit later, Hemant, Rustagi, CEO of WiseInvest, will join in to talk about the difference between saving and investing. Yes, they're not the same. So what is the difference and what do you need to know? But first up, let me welcome Rajee Rajesh. Hi, Rajee. Thanks very much for joining in. There is some confusion because interchangeably we use the terms income earned from mutual funds and capital gains. So first up, can you tell us what is the difference and also the tax structure?
Okay, so when we invest in mutual funds, normally the returns can be generated or realized in two forms. There could be dividend payments from the mutual fund companies, or the returns are also in the form of capital appreciation. That is, the NAV of the mutual fund units appreciates. Now, dividends, the taxation is pretty simple. Whenever a dividend is paid out, it is taxed in the hands of the investor as per the tax slab that the individual falls in. But capital appreciation is taxed only on realization. That is, you have to pay tax only in the year in which you redeem the mutual funds. Now, this taxation, the quantum of taxation, depends upon two important factors. What is the nature of the mutual fund that you're selling? Here, we have to classify mutual funds as equity-oriented mutual funds and debt funds. Debt funds would include any fund of fund or gold funds also. And equity funds would include arbitrage funds and balanced advantage funds. So this factor is very important. We need to understand what category the fund falls in and also the holding period of the investment. Depending upon the holding period, the investment will be classified or the gains will be classified as short and long term. Now, if we take debt funds, the holding period, if it is less than 36 months, then the gains are reckoned as short term gains and there is no change in taxation. The tax is as per the tax slab of the individual. But when debt funds are held for a period of more than 36 months, then they are classified. The long-term capital gains arising out of such redemption of debt funds is taxed at a flat rate of 20%. And also there is a very favorable indexation allowed, just as you have for immovable property. You can index your cost of acquisition. So the tax impact is almost negligible when you redeem debt funds after 3 years. Now, if we move to equity funds, the taxation is quite different here. Here, the period for reckoning whether it is short-term or long-term is also 12 months, which means if you sell a fund within 1 year, you would have to pay tax at a flat rate of 15% because it's short-term capital gains. But if you hold a fund for more than a year and sell it after, then long-term capital gains kick in and that flat rate is only 10%. And here again, the investors have an advantage of availing an exemption of 1 lakh in respect of long-term capital gains every financial year.
All right, Rajee, thanks very much for explaining that. But when we talk about capital gains, it's very important for investors to also understand the concept of grandfathering. This was a new concept which was introduced in the 2018 budget. So what does it mean for investors? How can they use it?
Yeah, so earlier, prior to 2018, as per our income tax structure, any gain, long-term or short-term gains, or long-term gains at least from mutual fund units redemption was completely tax-free, especially equity mutual funds. Now, this taxation of 10% on LTCG on mutual funds, equity mutual funds, was introduced in Jan 2018. And generally, grandfathering is the name given to a provision in which you have an old rule applying in some special cases whenever a new rule is introduced. This is what is grandfathering. In this particular context, the government did not want to penalize or increase the tax liability of investors in respect of the gains accrued to them before 31st January. On 31st January or on the budget of 1st February, this long-term taxation on LTCG was introduced. So the government allowed a facility called grandfathering, wherein when you are selling mutual fund units, you can split your gains into gains made before 31st January and after 31st January, and you are required to pay tax only in respect of the gains accrued after. If I take an example, supposing you have invested, say, 1 lakh in mutual funds around 2010 or something, it's quite likely your value of the mutual fund would have been, say, 4 lakhs by 2018, and then you sell it after a couple of years. Say you sold it last year for 5 lakhs. You invested 1 lakh and you made 5 lakhs. So your capital gains would have ideally been 4 lakhs. But since the taxation was introduced only in 2018, by grandfathering, you would be required to pay only tax on 1 lakh, which is the difference between the value of the fund on 31st January and the value on the date of sale. This is a facility available and it's known as grandfather.
Okay, so Rajee, now tell us, how do you offset capital gains, both long-term and short-term?
Yeah, this is again a very important concept because equity markets are subject to volatility and it's quite likely there might be loss on sale of certain securities. So if an investor makes a loss on sale of his units, equity-oriented mutual funds, he is allowed to adjust this loss against gains. He might have sold some investments at a loss and some in a profit. So this loss and profit can be set off and you are required to pay tax only on the net capital gains. But here some rules are applicable. It says that long-term capital loss can be set off only against long-term capital gains, whereas short-term capital loss can be set off against both short-term and long-term capital gains. So which means you have to be careful when you try to adjust long-term capital loss, whereas short-term capital loss can be adjusted against any form of gain. Another important aspect is, if you are supposing not able to achieve this set off completely in one particular financial year, you don't have gains at all, whereas you have made losses because the markets have been dull through the year, you're allowed to carry forward these losses and set it off against future gains made for you in the subsequent financial years for a period of up to 8 years. So this is a very important facility, and investors should be careful of carrying forward this losses, capital losses in their income tax returns. And for this very reason, even if you don't have tax liability, it makes sense to file your returns because this facility of setting off, carry forward and set off is available only if you file your return of income.
Okay, but Rajee, how much emphasis should investors actually give to the tax impact when they're looking to make portfolio decisions? How important is it?
See, taxation is a big factor to be considered while you're assessing returns on your investments. Supposing your tax-adjusted returns should only be considered while making a choice between investments. For example, fixed deposits could give you 5.5–6%, but if you end up paying 30% tax, your net effective rate of return is 4%. So this is a very important factor. But when we come to making portfolio changes, again, we have to be aware that whenever you make a change, you have to pay a tax on the realized gains. So frequent churning should be avoided. But typically the circumstances when we have to absorb the tax and make the change in portfolio or within mutual funds is when you require funds for realization of your goals. Obviously, you have to sell the mutual fund and use the money. You have to pay the tax. Sometimes when you decide to move from an underperforming fund or an underperforming sector to another sector, those kind of changes which are driven by performance considerations, also you have to absorb the tax impact. And of course, if there is an asset allocation change that you have to do in your overall portfolio because your equity has suddenly become very high, or you want to increase your equity component, those kind of changes would also require you to, in those cases, you would have to absorb the tax impact and then make these changes. Otherwise, frequent churning should be avoided because the taxation impact would be high on such kind of transactions.
Okay, and Rajee, finally, can you leave us with some tax planning ideas?
Yeah, so a couple of things which investors should keep in mind is, especially when you don't need your fixed income allocation for a period of 3 years, debt mutual funds are a very important factor to consider because they are very, very tax efficient. If you hold them for a period of 3 years because of indexation, you end up not paying any tax. So an allocation to debt mutual funds, especially for individuals who are in the tax bracket of 30%, is very important. And then there is something called capital gain harvesting, where if you're having profit-making securities, I told you earlier that there is a exemption of 1 lakh in respect of every individual has a 1 lakh exemption every financial year. Now, you cannot accumulate this over 2–3 years and claim it. So it makes sense for you to book your profits up to the tune of 1 lakh in every assessee's name. Supposing you're a family of 3, you're investing in your name, the name of your spouse and an adult child, then in that case, booking profits in each of their portfolios and harvesting this gain to the extent of 1 lakh every year makes a lot of sense because you would be saving tax to the extent of that 1 lakh in every assessment. And finally, of course, now that dividends are taxable based on your tax slab, it is advisable not to use the dividend option at all in mutual funds. If you have some funds still lying in old dividend options, please make a switch to growth funds. And if you need regular income generation, Systematic withdrawal plans or SWP mandates are a more efficient way of drawing the money and saving tax.
Rajee, always a pleasure to speak with you. Thanks very much for explaining this concept. On that note, a very quick break. On the other side, we'll connect with Hemant Rustagi, CEO of WiseInvest, who's going to talk about the difference between saving and investing. Stay tuned. Hi, welcome back. You're watching MF Corner, and with us now we have Hemant Rustagi, CEO of WiseInvest. Hemant, thanks very much for joining in. So today we want to talk about saving and investing and what is the difference, because often, we hear people using these terms interchangeably. So can you set the record straight?
Well, Sumera, I agree with you. I think there are most investors who believe that saving and investing is the same thing. Then, of course, there are investors who believe that investing is all about putting money in your bank account and that's enough. While I would say broadly, the objective of saving and investment is to secure your financial future by following a disciplined approach, there are a number of reasons why investing is completely different from saving. Of course, one has to save first to be able to invest, but it's investing that helps you retain the value of your money over a longer period of time. So let's understand what the basic difference between these two. When we talk about saving, it's actually putting money in a bank account. So obviously the returns are low, the liquidity is very high. The approach to saving has changed over a period of time. Earlier, I think saving used to be a leftover from income after expenditure. But having realized that this is not the approach which allows investors to save regularly and save a particular amount every month, the approach changed to saving first and then spending. I think over a period of time, we have seen the approach to saving has changed. But the job is basically, when we talk about saving, it's just to keep some money aside out of your income. When we talk about investing, investing is basically when you buy assets like equity, debt, real estate, or commodities, with the expectation that they will earn healthy return for you over a period of time. So investing is broadly, I would say, a long-term process. It requires you to do certain things. It requires you to decide your asset allocation, choose the option that can give you the best from that asset allocation, and understand the risks which are basically attendant to investing in these market-linked products. So investing requires you to have knowledge, investing requires you to understand risk. So you can see that saving is what you keep aside out of your income, and investing is when you put your money to work. And that is what, like I mentioned earlier, allows you to kind of retain a value of your money over a longer period.
Absolutely. And, it was said that wealth is not earned, it is saved. Now, I guess we need to just alter it and say it, what is invested. But Hemant, even for low-risk investors, is there any merit in just saving, right? Or one should, even low-risk investors should try to strive this balance between saving and investing?
I think this is a very important question. I think many investors struggle to find answers for this, especially when we talk about investors who have a low risk appetite. Look, I think we need to understand there are two risks that we have to kind of face when we invest our money as an investor. The one is risk to capital, the other one is risk of inflation. Unfortunately, most investors in our country focus on risk to capital. But that's exactly the reason why many people still think that saving is equivalent to investing. In reality, when you invest for the long term, let's say when you're talking about building a corpus for your retirement planning or your children's education, you're investing for 10, 15, 20 years. Even if you build a portfolio of equity, 100% equity, the chances of losing money are not there if you're a disciplined investor, unless you are a totally irrational investor and you're making changes haphazardly in the portfolio. So the fact is that even if you're a low risk investor, you need to realize that you need to, like I said earlier, the investing is staying ahead of inflation over a longer period. It's very, very important for every investor to understand. Unfortunately, there are strategies, there are products, when especially we talk about investing in mutual funds, that whatever it may be your risk profile, whatever may be your time horizon, there are products for you. There are hybrid funds, there are debt funds, there are debt-oriented hybrid funds, there are equity-oriented hybrid funds, there are dynamically managed asset allocation funds. So irrespective of the fact that you may have a low risk profile, you can still actually build a portfolio, and that's where your focus should be. So it doesn't matter whether you're a low risk or a high risk investor. I think every investor has to understand the difference between investing and saving and make sure that in the long run, their money grows not only in terms of number, but in terms of value.
Okay. Hemant, for both saving and investing, there are certain products or options that people would choose, right? The very obvious ones. What are the tax implications?
Well, look, I mean, when we talk about saving, generally, like I said, saving is like putting money in a bank. And now what happens many a time, because the returns are so low, investors, focus more on the quantum of tax that they pay. And they feel that I'm paying very low tax. But the reality is that you're paying in terms of a percentage very high tax, because whatever interest you get from the bank account or a bank deposit gets added to your income. And if you're an investor paying tax at the rate of 20% or 30%, your tax outgo is very high. When we talk about investing, I think it's very, very important to follow a tax-aware investment strategy, and that's the benefit of investing in market-linked product. If you're investing in equity or equity-oriented funds, if you redeem your units after 1 year, you pay tax only at the flat rate of 10%. So clearly, investors in the high tax bracket benefit in two ways. One, obviously, the tax outgo is much lower, and second is every investor who invests in these funds over a period of time actually give themselves a chance to get higher return. Similarly, when you invest in the debt fund, mutual funds, compared to a bank account, if you keep your money for 3 years or more, it becomes a long-term capital gain. You get indexation benefit and you pay tax at the rate of 20% after that. Let's understand by a simple example. Even if your return is 7% and the inflation is 6%, you're paying 20% on 1%, which is 0.2. So your post-tax return is 6.8, which will be much higher than what you get from bank account. So I think it's very important as an investor to follow a tax-aware investment strategy, because that can make a significant difference to what you get to keep at the end of your investment time horizon.
Okay, and just finally, Hemant, is there any rule of thumb about how much money goes into savings and how much should go into investing? What would you recommend?
Well, again, Sumera, I think very important aspect, even though there is a thumb rule of 50, 30, 20, which says that 50% should be for expenses, 30% for want, and 20% for saving. But at the end of the day, it's a thumb rule. I strongly believe that the problem with following the thumb rule blindly is that they do not take into account your personal situation. Whereas as an investor, you need to really focus on that. While it's absolutely important to have these three compartments, but how much will go into that will depend on your own situation. That's where I think the goal-based investment process, which has become very popular over the last few years, I think works out well. So what happens is you define your goal, short-term, medium-term, long-term. You set a target, you have a time horizon, you work out based on assumed rate of return, how much money you need to invest. Now, these goals will also involve creating an emergency fund, which is what you do through saving. Then there could be objectives like buying a car or going for a family vacation. The fear that most investors have is that if I plan too much about future, I will have to compromise on the present. That also does not have to be done. So here, when you follow a goal-based investment process, you know exactly how much you need to invest. So you go work backwards, do budgeting, save first, and then invest. So I think it's important to follow a goal-based investment process. This kind of thumb rule can be just an indicator, but don't follow it blindly.
All right, Hemant, thanks very much for joining in and for explaining this concept to us. With that, we're going to wind up on MF Corner for now, but do remember to keep sending us all your queries. For now, stay tuned. The team of Closing Bell joins you next.